If you're a trader on a floor like these guys, or it's just you with a terminal, a key component of success will be dependent on your temperament and your personality.
There is a danger that we get very wrapped up in markets through our own personality. I would go so far as to say if you're an excitable personality, you're probably attracted by markets, and actually that attraction might be part of your downfall.
So what can we learn about our personalities and our attitudes to risk and decision making? We're all, of course, prone to various biases. Here are three to be aware of. The first, Gerald terms, is anchoring.
This is really susceptibility. If I plant a seed in your mind, that can be very strong and in the front of your mind. So, you know, the classic one, if I say don't think of an elephant, the first thing you think of is an elephant. And I think when we look at financial markets, we're often very attracted to one dominant fact or dominant story, which might be a market shorthand, but might actually be masking what's really going on. So I think we have to be careful of that.
Of course, we all have aversion to losses, but get real.
Nobody wants to be seen to be taking a loss, and I think there is a tendency to hang on and hope things will get better. And this is a slippery slope to disaster if one's not careful. It's also a very good sign of how disciplined your trading strategies are. If you haven't got a disciplined plan, you're much more likely to sort of hang on and hope things will get better. And you may suffer from this illusion of control, this feeling that you know what's going on and the market doesn't. That's incredibly dangerous.
As for the real wealth destroyer, do you recognise what Gerald calls the sunk cost bias?
This is when we put so much money into something we can't afford to give up on it. Curiously, we see a lot of this outside financial markets. We can all think of government projects where huge amounts of money has been spent, but nobody really wants to take the decision to stop the project because it's not working. Very similarly in financial markets, you take a position, you find it starting to run into loss. Instead of admitting you're wrong, cutting it and getting out, you hang on and sometimes even more dangerously, you pour money into it. You have a lot mentally invested in that investment or project, and so you don't want to give up on it. It can be very hard to cut a losing position.
So, Gerald's top trading tip?
I think awareness is the most important one. None of us are masters of the universe. We all would like to be. Try and have a very disciplined plan. Something curious seems to go on in the brain that if you actually write a plan down, and I mean write rather than even type it out, it seems to gain some sort of strong credence in the mind. So make certain that you've got a strong trading strategy written down, keep a daily journal and record your triumphs and your disasters. Always easy to record the successes, tougher to examine yourself when you've got losses, but it's a critical thing to do.
As a trader, you're faced with two opposing forces, the inherent uncertainty and instability of the marketplace, and a deeply held personal desire for certainty, comfort, and control. Now, this tension is absolutely central to how we address the markets, their volatility and predictability. But beware the illusion of control.
We see this a lot again outside the financial market arena where experts are very unwilling to change opinions. They're often the last people to be swayed on a change because after all, if I'm an expert, why in the world wouldn't I be right? Now, in the sort of hall of mirrors that is the financial markets, where you've got a lot of ideas, rumours, gossip, strange facts that come and go, constantly bouncing in and out, there is a tendency to pick on a few things you think you really understand and then believe you fully understand the market. And this again is a road to dangerous losses if you start believing you're right and the market is wrong.
So if you recognise yourself in any of that, how can you change what could be pretty perilous behaviour?
It is really simple, and I am going to sound like a broken record. I think it's simple but not easy. It's the great old American adage of plan your work and work your plan. I think far too many people plunge into trading. In fact, that's an old 1920s term for speculators, so-called plungers. People plunge in without really thinking about what they're doing. They get a little overexcited. So what you need to do is, a long time before you do that first trade, work out your plan, work out your strategies, and in particular, work out what you're going to do when you have losses. which you will have. Every trader has losses.
Hope is a virtue, we're told, but in the unforgiving world of financial markets, it can be a curse. It's an admission our trading discipline is starting to slip. Hope, mope, and dope. Gerald Ashley explains.
Hope, mope and dope, another great old adage, you know, you live in hope in a market position, then you start moping when it goes wrong. Bear in mind, you haven't taken any action here, you've been hoping and moping. When of course the inevitable happens and you have to take your loss, you feel a real dope, and you may well say to yourself, well, I won't let that happen again. Well, it's a well-worn path and sort of tendency for people to go around that loop.
Hope is a key emotion in trading, of course. It's what underpins falling markets.
People who are long in a falling market just keep hoping that it will get better. What they fail to do is to take action and to actually cut their position. One might even say they're almost religious traders, in that they're praying all the time rather than taking action.
And perhaps you think hope is the dominant emotion in rising markets. Think again.
And maybe slightly bizarrely to some viewers, I believe bull markets are driven by fear. And I'll tell you why that is. It's fear of missing out. When a market starts from a bottom and starts climbing up, more and more people join in. There's a sort of body of excitement that starts to build. Then people get a little bit fearful, thinking, well, my friend or my neighbour or my relative is making money in this market. Why am I not doing so? I must overcome my fear and jump in. And I think you'll find on many occasions when markets are priced for perfection, you find there's no fear left and we're at the top.
And here's an interesting thing. We feel the pain of losses at twice the rate we feel satisfaction of any gain. In fact, the psychologist Daniel Kahneman won a Nobel Prize for his work here.
What he found was that in times of when things are going well, we feel quite nice about it, but we really feel tremendous grief and pain when we're making a loss. And we will do much more to try and get that loss back than when we're in a situation of profits. So to put that in market terms, it means we often cut our profits too soon and we run our losses too long. Not only do we sometimes run our losses, we start taking some pretty bizarre and irrational decisions, like maybe increasing the deal size, the position size, hoping that, that word again, hope, that by averaging our price down, we're going to make things better. But we're really in headless chicken territory, I think, then. And there is something about, I might use the term, get out of jail. If you've been underwater in a position and you get back to a flat position in terms of your profits, you actually feel a form of relief. Anything to avoid that pain.